Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Our goal with this podcast is to sit down with top market practitioners, authors, educators, traders, money managers, strategists, to talk about the market conditions, to unpack their ways of thinking and their routines, their approach to investing, highlight some of the areas where they're seeing potential opportunities, and learn from their experiences navigating the financial markets during uncertain times. Today, we have a really good guest for you, Jesse Felder. Jesse's the editor of the Felder Report. I've known Jesse for a number of years. He's actually based part of the year here in the Pacific Northwest, down in Oregon. And met Jesse years ago because he got his start on the Stock Charts platform, where I was chief market strategist for a number of years. I was able to interview Jesse a number of times in my role there, and so excited to get him onto the podcast here for the first of what I hope are a number of conversations over time to update on his thinking. I'll tell you what you can expect from a conversation with Jesse. A couple things. Number one, a great long-term perspective. What always strikes me is I bring someone like Jesse on, and in my head I'm thinking about a recent move in the markets. I'm thinking short-term. I'm thinking flickering ticks, market volatility. And Jesse comes in with these long-term weekly and monthly charts. This is an area we actually talked about in particular in the interview, sort of the when in doubt, zoom out mentality, right? When things get uncertain, when things get crazy, zoom out, bring in more data, try to bring in, or provide greater context or broader context to what you're seeing. I would also say just a wealth of market knowledge. Jesse's a great sort of encyclopedia of market history and does a great job of reminding us what has happened in previous cycles. Because as much as this time is different, as much as this particular environment feels unique and unprecedented, there's always some historical parallel you can draw, right? There's always some historical period which you can draw some comparisons to, at least to inform your decisions and decision making a little bit better. In particular, we talked about some of the strength that we've seen recently in growth stocks. Names like Apple and Nvidia were the two that we talked about. How a lot of them have had significant runs. He sees that as a counter trend rally and really nearing a potential topping point. We talked about opportunities in energy. We talked about crude oil prices and energy stocks, oil and gas producers, and some of the longer-term trends that he's seeing, which suggest further upside there. We talked in particular about the XOP, and you'll see the alert that I actually have set after hearing Jesse's comments. We also talked broadly about balancing a macro perspective with the charts, why analyzing charts in a period of market instability still makes a ton of sense. And then at the end, I asked him what books he'd recommend. Some really good suggestions in there, a book or two that I would certainly encourage you to check out. We put links in the description below to access those books. So please enjoy my conversation with Jesse Felder, the editor of the Felder Report. Super excited to be sitting down today with Jesse Felder. Jesse's the editor of the Felder Report. Jesse, you and I have spoken a number of times on Stock Charts TV, and I'm super excited to have you join the podcast. Welcome back.
Yeah, it's great to talk to you again, Dave. Been a little while.
Yeah, it has been a while. You're a fellow Pacific Northwesterner, although you split time in Southern California, but heading back this way soon, I know. So obviously a volatile year. I'm super excited to catch up with you because you have often brought some proper long-term perspective to help us make sense of short-term noise. And I feel like this is one of those times where that's kind of the story. Talk to us before we get to some of the charts that you brought. Give us a sense of where your head is at in terms of the broader equity environment, particularly with the sell-off we had into the April low, a severe rally off of the April lows, which I feel like all the bulls that were sort of running away now super invigorated that this is the beginning of the next recovery. Where are you at given the V-shaped bottom and where we're at here today, mid-May?
Yeah, well, the probably the most important indicator that I look at to try and gauge where we are in kind of a market cycle is the insider sell to buy ratio. And that's just the total dollar value of, equities sold by insiders, the top CEOs, CFOs, directors of corporate America versus the total dollar value of purchases made by insiders. And you look back over a 12-month window, And that's a really good indicator of the direction, the likely direction of stock prices and earnings over the next 12 to 24 months. And so, insiders got really bearish last year. In
Mm,
fact, we saw the sell to buy ratio was above 20 times for most of last year. And it got that high kind of in late 2021. And it was a good sign that insiders anticipated earnings were going to be weak and the economy and eventually stock prices in 2022. They turned pretty bullish early in 2022, and insiders are generally very early. And they remained bullish throughout that whole 2022 kind of bear phase in the market, which was
yeah.
a good sign that they were more bullish than people, the average kind of Wall Street forecast by the end of that year, and set up a good, it turned out they were very accurate in terms of what to expect for 23 and 24. But as I mentioned, last year they turned very, very bearish again, and that's a good leading indicator for earnings and stock prices over the next 12 to 24 months. So I think probably what we're looking at is the beginning of kind of another bear phase in the market right now. And I'm looking to see insiders turn bullish like they did in early 2022 to kind of give me a sign that they see some light at the end of the tunnel. They see
Hmm.
after this, earnings kind of decline that they are in aggregate anticipating that they see an improvement, starting to materialize, down the road. We haven't gotten to that point yet. So it was interesting to me to see during this sell-off, you really didn't see insiders step in and get bullish in the way that they did in 2022. So that's kind of something I would be looking for to really see, like, okay, wow, the guys who run these companies are really starting to get interested in buying their own shares. That's just not happening right now.
Mm. I mean, you're definitely hearing, at least I'm hearing plenty of skepticism in terms of, long-term impacts of a lot of the decisions that are being made here recently. Talk to me a little bit if you could. I mean, when I think of your work, Jesse, again, you've often brought some long-term charts, and I find I'm so focused on what's happening day to day, and you're thinking more longer term. Can you talk to a little bit about how you've learned to navigate periods of short-term instability, stay centered on a long-term investment theme? I mean, how do you stick with the long-term trend when the short term is so noisy that it's so hard to, or so easy, I guess, to get drawn in? Any words of wisdom on how you sort of approach that?
Yeah, I really think that, gosh, I read a statistic in the Wall Street Journal, I think it was last week, that the average investor spends about 3 minutes on research and researching
Three
their,
whole
their
minutes,
trade
huh?
ideas. That's literally average. And
Wow.
75% of that research is spent on looking at stock charts, but that those stock charts chart 24 hours worth of trading activity or less.
Oh,
And so, I mean, it's hard to believe that it's a 1 or 2 day stock chart that people are looking at to make decisions on whether they're going to buy today or not. And
wow.
so I think there's a really terrific value in zooming out and looking at longer term and really kind of marrying your time frame with the time frame of the charts you're looking at. If you're a
Mm,
long-term investor and you're looking at even a daily chart, you're probably not aligning your time frame very, very well. I think for a longer term investor, you want to be looking at weekly and monthly stock charts. If you're day trading, yeah, great. Look at the daily charts. Look at
yeah.
the hourly charts if you're kind of a more frequent active investor. But I think for most people, looking at weekly, monthly time frames is kind of a valuable way to kind of keep some perspective.
Oh, I love that, Jesse. I love that answer. And again, I feel like a lot of traders feel like they're missing out if they look too long term, right? If you look at the weekly chart, right, you're missing out on all the action, but arguably you're missing out on the whole point, right? If you're zooming in too much and you're not understanding the context. I think that's really well said. Let's look at a couple charts. Could we I mean, so the S&P 500 obviously, gapping higher, sort of trading higher and nearing that 6,000 level again. Start off just overall when from a technical perspective, how are you approaching the current look of the S&P? Are there particular levels that you're watching, or what's your sense about what we should be looking for here in the weeks and months to come?
Well, one of the things I like to do, and I learned this technique from Michael Oliver, who runs Momentum Structural Analysis, And you can use this in stock charts. It's a PPO indicator. And so it's looking at kind of isolating or measuring the momentum of these charts. And a couple of charts we'll look at later, I use these indicators on a certain time frame. So on the S&P, there's two things in particular I'm looking at right now. On Friday, we triggered a new DeMark combo sell signal on 13 sell signal, daily sell signal. So that is a trend exhaustion signal that was triggered on Friday. Which is, it takes 13 bars of a pretty strong price strength before you can get that type of a sell signal. At the same time, if you look at the price relative to the 200-day moving average, excuse me, a lot of people just look at the price, exactly versus that 200-day moving average. But when you use something like the PPO, you can look at levels, and you can see that rarely did it come down and test the 200-day moving average during this uptrend. The stock market typically bottomed at a level that was really about 3% above the 200-day moving average. And so when you isolate momentum, you can see that the real support level for momentum was kind of this level that was roughly about 3% above the 200-day moving average. We're right back to that level. So from a momentum structure, we kind of broke down, not just below the 200-day, but before we broke down the 200-day, we broke down below that kind of support level above the 200-day. Now we're back to kind of testing that from below. So I think there's a momentum structure overhead. We're going to look at Apple and Nvidia in particular to see kind of how that's isolated. I think there's you can see just kind of some technical price action, simple price action overhead on the stock chart. But from a momentum structure, it's a more significant structure overhead that I think it'll be difficult for the market to overcome without some real significant participation inflows into the equity market.
Really interesting. So we have a couple charts. Do you want to go to Apple first, or do you want to start with the crude oil chart? What sounds good?
Yeah, let's start with the Apple chart.
Okay. And when you sent these, by the way, Jesse, I saw the 9s and 13s, so I would assume we would be talking about DeMark indicators at some point, which is great. So go ahead.
Yeah, so I wrote those in. I drew those in on the chart. This is a weekly time frame of Apple shares. The 9 is the DeMark sell setup, and the 13 is the actual sell signal. That's a DeMark sequential time frame, and you can see in this case it actually nailed the top within a week.
Yeah.
But what kind of I think is especially interesting about this, you have just a simple uptrend line on the chart that was broken to the downside, and we're kind of testing that from below right now. But when you isolate momentum, and this is the kind of the indicator I'm talking about before, you can see there's a very clear momentum structure. That basically defined the uptrend from 2023. Momentum remained kind of in this uptrend structure. Well, this momentum structure was broken to the downside in this recent decline. And now we kind of remain below this structure, which is kind of a clear indicator to me that this uptrend is over. And unless you can kind of regain those momentum levels, you're likely in a downtrend environment in the stock.
Ooh, I love this chart. Yeah, so using the PPO indicator, really just looking at where we're at relative to, in this case, the 40-week exponential moving average, and we've rallied up to that same trend line that we had off of the lows, and really puts this really, I would guess, makes you label this as a counter trend rally off of the April low. Then,
absolutely.
Is it a similar picture with Nvidia as well, or a little different?
Yeah, it's actually an even clearer picture in Nvidia, I think. Like if you look at this level of the price, I mean, I think just from simple technical analysis, you could see it's potentially forming a head and shoulders top pattern here over the past year or so. But when you use the PPO, you can see the same thing here. The uptrend is very clearly defined with a level of the price relative to the moving average above kind of that 12% level. So you can see kind of essentially the price never really broke below, momentum never really broke below that level until we had the DeepSeek episode earlier this year, and it broke to, that's when momentum was broken. It was right on that DeepSeek announcement. And now we've kind of remained below this kind of key momentum structural level, which tells me that this uptrend is potentially reversed to a downtrend structure. And as long as you kind of remain below that key level, you're likely in a different trading environment than what you came to see over the last few years.
It's so interesting, and obviously, I mean, these are stocks that there's been a lot of believers on the rally off of the April low. I guess I mean, the question would be, what would you see that would validate? Because I think a lot of people are really sort of in an optimistic frame of mind on some of these names off the lows. Is there something you would see? Is it just as simple as validating this head and shoulders top and breaking down below that pattern? Is it the momentum failing here that might suggest to you that, yes, that was definitely a counter trend rally? And the reason why I asked is because I feel like as much optimism as we see, it wouldn't take much to get people really scared all over again because of how
Yeah.
fresh that March, April sell off is. How would you think about that? I mean, is there a trigger or a level that would sort of validate this in your mind?
I think the way I like to use these momentum structures is kind of, as long as you're in the, I mean, you basically use it as a simple moving average, right? A
Yeah.
lot of people will just say, as long as we're above the 200-day, I'm going to trade from the bullish side. We're below the 200-day, I'm going to trade, I'm going to sell rallies. And I think,
Mm,
this is kind of just maybe a little bit more sophisticated way of doing that, but kind of looking at the structure is not necessarily the moving average itself, but it's below a certain kind of structure created by that moving average. So I think, to me, that yeah, as long as you're kind of below this level, you'd kind of trade it as if it's still below the kind of the key moving average, whatever that might be, to kind of indicate downtrend versus uptrend. Do I want to buy dips or do I want to sell rallies? And I think unless it can overcome that momentum structure, that key line in the sand there, then you probably
yeah.
want to be selling rallies and not too eager to be buying dips in this thing.
I got it. Yeah, so it sort of gives you an overall bias with which to think about the chart, right? I like that a
Yeah.
lot. Now, the question obviously then goes to what is working. Let's talk about some of the other charts that you sent. Here's crude oil versus gold. Let's start with
Yeah.
this ratio here.
Yeah, I know we've talked about gold a few times that I've been on, and I've been very, very bullish on gold. This is one indicator that I use kind of, if you are a commodities bull broadly. It'll tell you which one to favor, oil or gold.
Hmm.
When this thing spikes, it's usually oil is overvalued relative to the gold price, and when it plunges, you can I guess infer that oil is cheap relative to gold. And so, you can see back in 2020, when it hit all-time record low, that was generally a good time to be buying energy stocks and kind of phasing out of your gold stocks. Gold had a terrific run into 2020. And kind of peaked and rolled over around that time. And that was a great time to actually get into energy stocks. And at those relative peaks on either side of that was actually a great time to rotate out of energy, because oil was relatively expensive, and favor buying gold. I mean, look at that. Back in 2022, the oil price was telling you it's overbought, time to rotate out of your energy stocks and favor more, go maybe favor gold and the gold mining stocks. And if you bought the gold mining stocks back in 2022, they're up 150% or something over that time frame. So I think right now the message is, the oil price has only been cheaper relative to gold, back at that 2020 low. So oil is very, very cheap. It's probably time to start favoring oil and energy stocks over gold and the mining stocks right now, which have had a terrific run.
Let's take a look at the XOP then, right? So this is one of the energy ETFs we can consider. This is oil and gas exploration and production, sort of the
Yep.
inverse head and shoulders pattern, right?
Yeah, and I mean, this is a very long-term time frame. This is a multi-year, basing pattern that encompasses the 2016 crash in the oil price, which really kind of marked, the beginning of a longer-term bear market for oil. Oil eventually went on to make those, go negative in 2020, which is kind of the head of this, this bottoming pattern. But we have the PPO here too, and we're just looking at price versus a 36-month moving average. And you can see that, there's a very clear downtrend on this chart that lasted for about a decade, right? Oil price peaked in 2008-ish, and the stocks continued and made a relative high a few years later. But the momentum of the rally had been weakening for years and really kind of bottomed back in 2020. The rally we saw out of the 2020 low represented a major move, a major reversal that kind of changed this thing from downtrend to uptrend. And now we've seen kind of a consolidation in momentum where it's just basically moved sideways for a time and formed potentially a right shoulder on the chart in the longer term head and shoulders bottom pattern. So, if it also kind of fits with the macro theme that I've been following, which if you believe we are kind of in a stagflationary environment and entering into a kind of a longer term environment of higher interest rates, higher inflation, weaker growth, the energy is typically the best performing sector in that type of environment. So the fact that it's potentially technically forming a long-term bottom, and I'd want to see a major breakout above that neckline to really kind of confirm the thesis. But the idea that, we're potentially in a stagflationary environment, energy could go from, a laggard over the last couple of years to kind of leading relative performance to the upside. This chart tells me that, we're in a multi-year bottoming pattern for this, and it's something to pay attention to over, something to keep an eye on over the next few years.
It's such an interesting chart. And again, great long-term chart among many. This is a monthly chart of the XOP. I made a note as you were talking to set an alert for the XOP over 150, because that would mean clearing that pattern and breaking out. I mean, energy's been an underperformer now for a while, obviously, but certainly showing bottoming signs as you're showing. While others
it's interesting to me that it's underperformed for the last couple of years. But if you look back on a 5-year look back, the energy sector has still outperformed the S&P 500 on a 5-year time frame. So that's how strong the outperformance from 2020 to 2020 through 2022 was that even with the underperformance over the last couple of years, it's outperformed the S&P 500 on a 5-year time frame. So I think, that to me is a message. The strength in the gold price is potentially saying we're in a stagflationary environment, time to favor real assets. And if you start to see energy really outperform, that would be another confirmation that it's time to kind of favor real assets versus financial assets.
I love this. If you had told me or asked me to guess, has the XOP outperformed the S&P for the last 5 years? I don't know if I would say it would have. Charts are a great myth buster, right? As one of my analysts at Fidelity used to say, they're the truth serum for the markets. I love that chart. Tell me this, Jesse. So we just spent some time looking at some charts, showing potential upside exhaustion on some of the growth names like Nvidia and Apple, showing a potential rotation in energy. We're in an environment here in 2025, similar to previous times I've experienced in my career, where it feels like a very macro-driven environment. And in my market recap show, I often get a question along the lines of, this is all about news headlines and policy changes and geopolitical stuff. Why should we even look at charts? Because it's all about the headlines. How would you respond to that? Or how do you think about the value of charts and looking at price momentum when it feels like such a macro-driven environment?
I mean, it's a great point. I think even all of the great macro investors, you look at somebody like, Paul Tudor Jones has basically said, I almost don't even care about anything other than the 200-day moving average, right? Is the price above the 200-day moving average, I want to own it. If it's below the 200-day, and he'll have, all kinds of macro, trading themes and whatever, but the ultimate arbiter for him is it in an uptrend or a downtrend? And so technicals are absolutely a key component to marry with a lot of these macro themes. So, I do a lot of macro work myself. And so, the macro, I think, case for investing in energy is the greatest driver for the relative performance of energy, whether it's down or up, is going to be the trend in the dollar and capacity utilization. So is the dollar in an uptrend or is the dollar in a downtrend? And is capacity utilization in the economy, essentially manufacturing activity in these things, is it growing or is it weak? Over the last 10 years, we've had a strong dollar and a weak manufacturing recovery from the great financial crisis, which explains why energy has done so poorly for so long. If we're now switching into a dollar bearish environment and increasing capacity utilization, deglobalization, reindustrializing the economy, these things. And that is the macro bull case for energy. But I want to look at the charts. I want to make sure the dollar is in that downtrend. I want to look at, what's going on with the dollar, and I want to look at the energy stocks themselves. What do they look like? Do they look like they're basic and breaking out? That's going to be the ultimate confirmation of that macro theory.
I love that so much, and 100% agreed. Right, I feel you've sort of hit on a couple things. Number one, the charts often cut through the noise instead of what should happen. They tell you what actually is happening, which I think is helpful. But also just the fact that it tells you how investors are digesting all of this news flow, right, and what the expectations are, and if investors get optimistic or pessimistic or fearful or excited, the charts probably reflect that. That's well said, Jesse. Listen, so one final question before we go. We have a similar taste in books because I'm noticing the one that I'm just reading today
Nice.
is right behind you. So this is Range, which is all about, generalization as opposed to specialization, which I think are just fascinating implications for investing, which I'll probably do a video on at some point. Any other good reads that you've had recently that you think the viewers would be into?
Yeah, one, I just did a podcast with my friend Peter Atwater. His book is right here, the Confidence Map.
Confidence Map, yeah, okay.
It's such a great framework for looking at markets, for looking at understanding what's driving changes in politics, changes in the world, changes in markets. I mean, Peter is is a truly unique market watcher, and his framework for understanding confidence and how confidence drives prices, drives the economy is really valuable. So yeah, I recommend Peter's work for sure.
That's fantastic. Tell me more about the podcast. What are you and Peter doing?
I just had him on as a guest to talk about the book and talk about kind of how he's seeing confidence evolve in the markets. I finally, after a 2-year hiatus, just brought my podcast back, and I'm doing another episode here with Vincent Deluard, who's a interesting macro thinker.
Yeah.
And one of the questions I have for him is related to kind of this book Range. Is that it's something I like to ask people is, beyond specializing in the world of finance, do you have any hobbies or sports or just other interests that you think bring a kind of unique perspective and make you a better analyst, make you a better trader? Because I do believe there is value in that, a breadth of knowledge rather than a depth of knowledge.
That's fantastic. What's the podcast called?
Super Investors and the Art of Worldly Wisdom.
I love it. You've got a new listener today from me, and I hope others tune in as well. Jesse, listen, great to see you. Thanks again for being a great guest over the years, and thanks for sharing some insights today. You always bring some great long-term charts that I think help put things into context, and also sharing some good reads as well. So I appreciate that. So thanks for coming on today. I hope we can continue the conversation another time.
This was great, Dave. I always enjoy talking with you. Thanks for having me on.
Hope you enjoyed that conversation. I love the book recommendations at the end. No kidding, we did not plan that, but I go up and as he's talking, I'm looking in the background of his shot, and I'm thinking that's literally the book I have here. I'm about 2/3 of the way through it, and I've been highlighting and underlining and writing notes in the book as I go because I thought it was really good. So we'll have to keep talking about book recos the next time I have Jesse on the show. For sure. You see what I mean about that long-term perspective? He brought some weekly and some monthly charts. Great way to help make sense out of the market turmoil we've experienced in 2025. Zoom out, bring in weekly data, bring in monthly data, look at 5 years, 7 years, 10 years, and understand the big picture. That idea that energy has outperformed over the last 5 years, I mean, obviously that's true. Wouldn't have guessed that, right? And I think that's what the beauty of technical analysis is. It's as I said, a truth serum for the markets. It's a great myth buster, great way of really understanding what has happened. And I think, reflecting on some of those longer term charts and how they be reverting could be meaningful for investors here as we continue through 2025. Some interesting contrarian calls there with growth stocks maybe pulling back after their counter trend rally. Energy stocks maybe finally breaking out after years of struggling, to do so. Great take there, and thanks again to Jesse Felder, editor of the Felder Report, for joining us on the show. Put a link below to his website, also to his podcast, which I'll definitely listen to, and I encourage you to do as well. By the way, if you want to learn more about some of the technical approaches that Jesse and I discussed, indicators like PPO, long-term analysis of relative strength, how to use technical analysis on different time frames, or just the simple practice of identifying price patterns and potential support and resistance levels, if that's something you want to improve on in your own process, our Market Misbehavior Premium memberships may be a great opportunity for you to supercharge your own analysis of the financial markets today. 3 great benefits to the premium membership. Number 1, you'll have immediate access to all of our virtual courses. We'll start with Flight School Behavioral Investing, where we teach you all about behavioral biases. That's what happens between your ears, what happens in your brain, and also technical analysis, a practical set of tools to help you evaluate potential investments and understand the world around you as an investor. Second thing, you'll have access to all of our members-only reports, like our weekly flight plan, where we focus on key levels, patterns, and signals to focus on in the week to come. Also, our monthly chart review, where we apply our proprietary market trend model to a series of ETFs and asset classes. Finally, you'll have immediate access to our members-only community, a supportive space of like-minded investors where you can ask questions, where you can benefit from other investors learning their way through the behavioral and technical toolkit. And I'm in there every morning answering questions, providing some market observations, and just encouraging others to practice good technical practices or technical approaches. If that's of interest to you, those 3 great benefits and more, you can learn more at marketmisbehavior.com/premium. Don't forget to use the code PODCAST when you check out for 30% off your first 12 months on any plan. That'll do it for today. Thanks so much for joining me here on the Market Misbehavior podcast. Thanks again to Jesse Felder of the Felder Report joining us from Southern California. For Market Misbehavior, I'm Dave Keller, reminding you that it's always a good time to own good charts.